Good afternoon, everyone. I am Neil Shah, market strategist at Edison. Delighted to be joined by Gervais Williams, well-established fund manager in the UK small cap community. We are here to unpack the budget, Rachel Reeves' budget that came out yesterday. Gervais, let me start by, what do you make of the initial reaction to it? I think generally speaking, we've seen the market rally a little bit, gilts hold up reasonably well, etc. What's your take on it?
Well, I think a clear objective was to sort of, get a budget which didn't cause any uncertainty or panic, and to some degree she's achieved that. But actually, I think when you look under the bonnet, actually, it's a disappointing budget again. The last two budgets have been very much dominated by tax increases. She's had another tax grab again. She's taken really out all of the headroom for rainy days. So if we were to get a recession or setback in some way from here, then I think actually there's very little more that she can do in terms of increasing tax take. So whilst she's got away with it, it's fine. I think ultimately, I think it's actually going to be turning out to be probably a bad budget in retrospect.
Okay. And there's a sort of, I would say that the reaction was mixed. In particular, some concern about the back end loaded sort of fiscal tightening, and as you touched on, limited room for sort of financial headroom, etc. You do remember a year ago that she stood up and said that I'm putting this budget together so that I don't need to raise tax again. And here we are, sort of 12 months down the line. Is there a credibility issue starting to build for the UK?
Well, I think there's a longer term issue, which is that actually as a nation we've long been living beyond our means. What I mean by that is the government's deficits, the amount of money they borrow from all of us and overseas investors has for many years exceeded the amount which actually we save as a nation. So that's fundamentally an unstable situation, because although we're lucky we've got international investors who are happy to buy UK bonds, at some stage that won't be always the case. I think during globalisation, really the feature about globalisation was there was just a great amount of cash slewing around, debt was slewing around. It was relatively easy to borrow even in relatively extreme circumstances. Many of the zombie companies have survived. Unfortunately, the nature of nationalism is that actually we're a bit more on our own, which means at certain times it may be that there aren't kind strangers overseas who are happy to buy our bonds. So I do think actually the longer term we are going to get a crisis, whether it's 2 months or 2 years, I can't say. But I do think that this is all part of a pattern, unfortunately, which is adverse.
Okay, so I'm going to sort of take you through some steps now. So one, I just want to touch on immediate thoughts of sort of sector winners and losers. Then I want to touch on actually on a slightly broader basis, what does that mean for the sort of different asset classes within equities themselves, i.e. large cap versus small cap? And then we'll touch more broadly on the sort of UK market as a whole, valuation, discounts, etc. So let's just start off with when you sort of read through what sort of came through, was there any immediate reaction in terms of sectors who are going to do well out of this and sectors to avoid?
Well, quite a few sectors had actually come down ahead of it. So there was an awful lot of speculation, ahead of time. We didn't know which sectors we affected. There was an expectation that perhaps there may be some significant changes to the housing market. Of course, there was at the top end of the market, but stamp duty was largely unchanged. So from that point of view, certain sectors didn't get the benefits. On the other hand, quite a few sectors didn't miss out. CFD operators didn't get a special tax, and there were many other taxes which could have come through. So there was quite a bit of relief rally that I didn't get stuff this time. So I think there was a bit of that. In terms of actually kind of the bigger picture, I think the UK market has had a good year. It's come up quite a long way. And in a way, I think that's reflecting not so much the prospects for the UK economy, but much more the prospects for equity income stocks and all that kind of thing. And the main thing here is that actually the UK economy, it's not doing particularly well. It's probably not going to do very well. Bizarrely, I don't think that's going to be the main driver of return from here. So actually, although there may be, we can talk about individual sectors, talk about the gaming sector or online gaming tax and such like. I don't think they're going to be the key things we take away from this budget. I think what we will take away is actually that safe companies will actually have a stronger opportunity to not just survive but thrive. Unfortunately, less safe companies, zombie companies, for example, over-levered, loss-making companies, I think are more vulnerable actually going forward as well.
Okay. And when you think about it, I mean, you invest on a sort of fairly broad basis. I guess if you think about the sort of large caps and FTSE 100, which less domestically focused, but and with more international exposure, and then the FTSE 250 and the sort of more domestically focused sort of companies, is there any thinking in terms of a leaning towards one, or where you think there's going to be beneficiaries, or is it, as you say, really focus on the company fundamentals and the strength of the balance sheet?
I think what we've generally had the view, my personal view, has been that for some time now, actually, we're looking at a consumer sector which is under pressure. Last year, of course, we had the national insurance contributions increased. This year, whilst it may not affect the consumer sector, consumer operators that much, the national insurance contributions in terms of tax for pensions is going to be quite a big number. Okay, it comes in 28, 29, but that's going to be another big slug of cost for employers, potentially. So I think generally companies are under pressure on where they've got a lot of staff, particularly lowly price staff. As we know, the 18 to 21-year-olds have got quite a big pay rise again this year. So that's going to be on top of what was a good pay rise last year and a minimum wage going up. So I think generally consumer stocks are not going to be the ones which do well. I'm generally cautious, not just on hospitality, not just on retail, security, all these areas which have large numbers of staff. I think it's going to be an ongoing pressure to get the price increases you need to cover your cost increases.
Okay. In terms of then thinking about UK equities overall as a sort of an asset class, we've long talked about the fact that the UK has had a historic discount to its international peers. You're painting a rather sort of gloomy picture for the UK, but then that gloomy picture might extend to other countries. How are you thinking about asset allocation going forward, and how do you think UK equities are going to fare?
Actually, if I've painted a gloomy picture, it's this background, the economic background. But actually, the FTSE 100 particularly, but the UK generally, is actually dominated by companies which generate surplus cash. Now, don't get me wrong, they're not growing as fast as Nvidia and all the rest of it. Some of them are, but very few are. But basically, we're dominated by companies which generate surplus cash. And the reason I mention that is if we are going into a more uncertain time period, and really, I would argue the last 30 years have been dominated by globalization, plentiful immigration, generally labour has been plentiful. So whilst, it's been a terrific time for stock market returns and many of the wealthy have got wealthier, whilst we have seen pay rises over the last 30 years, we've seen comparatively lower pay rises compared with the wealth effect. And so we've got to a period really where over the last 10 and 15 years, most of the electorate are saying, to be honest, globalisation isn't quite working for me. And that's where Brexit came from. Yeah. That's where we're getting the sort of far right in Europe. That's where the clean sweep for Trump came from. So the reason I mention that is, I think the political sort of narrative has moved away from globalisation to nationalism. So me first, you second. And I think that's going to lead to an equally profound change in terms of the stock market weather. So coming back to it, I think companies which actually have the ability not just to survive, but actually in uncertain circumstances to take advantage of the weakness of others is absolutely disproportionately advantageous going forward. And it just so happens, nothing to do with the UK government, nothing to do with the UK economy, but just the makeup of the UK stock market is so very different from, say, the US stock market that actually... Yeah. This means that these companies, if we do get, increasing wage pressures because of immigration control, if we do find that in spite of layoffs, there's more militancy, and let's just remind ourselves, there is a general strike going on in Belgium at the moment, right? Then basically, we're going to see the cost of labour going up in a way we haven't seen for the last 30 years. I expect most companies to come under margin pressure. My working assumption is that global profit margins will halve over the next 10 years. And so companies generating surplus cash, first of all, they don't go bust very quickly under such a scenario, but so much better. Yeah. They start to get to a position where they can move into the vacated markets when the zombies go bust. Or better still, you remember HSBC bought SVB UK for £1 in 2023. an insolvent bank, which added
Yeah.
millions or billions to their market price, then we're going to get more opportunity for equity income stocks not just to survive, but thrive and get earnings upgrade. It's a long answer. I'm expecting the UK market to be actually primarily one of the best performing stock markets, bar none, for the next 20 years, irrespective of this budget.
Okay, interesting. There were some measures in the budget which, I think will impact the way people think about dividends, allocating savings,
Yes.
and we can touch on the sort of stamp duty reform for new companies. Let's get your take on the changes to the dividend tax, or the increase in taxes on dividends that was sort of introduced yesterday, and also this idea that we are reducing the amount that people can keep in cash in ISAs,
Yeah.
previously it was a match, but now if you've got £20,000, £8,000 of that needs to go into equities. How are you thinking about the impact of that?
Well, I mean, actually, although most of us invest for capital gain, buy something low, sell it at a higher price. That's obviously a very popular strategy for generating return. If you go over sort of 50 and 30-year periods, generally stock market returns are principally determined by the initial yield you get and how much it goes up. So whatever we do individually, when it comes to being institutional, insurance funds, pension funds, and all that kind of stuff, the income and the income growth is 10 times more important than whether the price goes up this particular 5-year period or that particular 5-year period. So coming back to it, then income and income growth is a really important feature. Of course, the UK market is dominated by equity income stocks. These are capital-intensive businesses. They put money into large, mines around the world, or potentially in sort of a complicated financial with a high financial, requirement. So coming back to it, they invest first and get a stream of income coming out. So coming back to it, as I said, I think the key issue is that I think capital growth is going to become much less popular. I think markets will spiral around. I think there'll be a devaluation of markets as the US market normalises. I think profit margins may well come down. So both those factors will probably mean that actually in absolute growth share prices, a lot of stock markets won't go up over the next 10 or 20 years, just like Japan after 1989. But I do think that good and growing income will become horribly important to clients. So coming back to the tax, it's just unwelcome. Having an extra 2% on income on tax from your dividends for private investors is unwelcome. Fortunately, they can do something about it. You can put something in ISAs. That's a very good way of generating good and growing income. If you're a gross investor, i.e. a pension fund or an insurance company, that doesn't make much difference either. So actually, in terms of behaviour, I don't think it's going to lead to a significant behaviour change. But I think specifically the UK leads the world, or one of the companies, the markets leading the world in terms of its income bias. I think income bias is going to become horribly important to clients. You get a rate of return even if the stock market doesn't go up. In your bank, I think that's going to become very important. So I think there's just an extraordinarily major watershed in terms of stock market weather coming, and it just so happens, as I say, nothing to do with the government or indeed the UK economy. We just happen to be in the right place at the right time.
Okay. So look, I mean, I've heard you talk about this, and if I look at the UK performance year to date, it's done extraordinarily well. The FTSE 100, I think, has outpaced the S&P certainly in dollar terms. I think you're seeing some catch up at the smaller end. And we do hear that international investors are looking to the UK for its margin of safety, for the income, diversifying out of markets like the UK. At the same time, you keep seeing stats about the fact that domestic UK institutions are seeing sort of asset allocation reduce. I'm just wondering how you sort of deal with that conundrum. When do we see our own sort of asset management community really start to ignite? And I asked this question really as a sort of a prelude to the stamp duty changes. That the hope is that if you remove stamp duty for new issues, that you might see some more activity in the London market. But I'm assuming you also need an attractive capital base in the UK to attract companies to come list in the London market. So how do you see the sort of market developing now? There's clearly interest in the UK market. When do we start to see more people starting to invest domestically?
Well, I mean, I'll probably push back on a couple of things. First of all, I don't think many people are putting money into the UK because it's the UK. I'm talking about international investors.
Yeah.
But I do think there's quite a sort of increasing interest in a lot of international investors putting money into equity income stocks. And it just so happens the UK
Yeah.
happens to be a very major beneficiary of that. So I don't think many people think, oh, yes, let's put some money in the UK. There is some, but not much. But what is interesting is that actually, currently, we've still got local investors streaming out. If you look at the Calistone data, for example, last month it was one of the worst months in the last 3 years. So coming back to
Yeah.
it, local investors can hardly sell fast enough at the moment. And what's interesting is, even in spite of that local kind of surge of exiting, global investors, whilst there's not many of them kind of thinking much about the UK, there's enough global investors, along with buybacks from the companies in the UK, to actually mean that the FTSE 100 is actually one of the best performing stock markets this year. So if we think of that, it's 22% up year to date. And that compares with, say, an S&P index in sterling terms, not in dollar terms, in sterling terms, of about 11. If you take maybe the Magnificent 7, 16, 17, small caps have been underperforming.
Yeah.
The AIM market's only up 5. In the US, the Russell 2000, which is their sort of small cap market, is only up 6. So these are all sterling figures. So coming back to it, actually, in spite of everything, and that's local political stuff, there's economic setbacks, worries about whether Nvidia is going to become even bigger and all that kind of stuff, right? What's been interesting is the UK is already, whilst local sellers are flat out one of the best performing markets, I would argue, what happens if local sellers stop selling so much, right? Actually, the UK just carries on outperforming. So coming back to it, I'm tremendously upbeat about the strength of the UK stock market this year to date. I think it's just the start of a long-term trend. I think it's going to surprise. If things get worse and we get a global recession, of course, we may find some local headaches. It may be the government runs out of money, unemployment goes through the roof. I hope not, but it could do. That will mean that governments run out of money. Maybe we get sterling crisis and we import more inflation and interest rates remain higher. I'm not saying this is all going to be wonderful, but actually, all of these things, because 80% of the earnings from FTSE come from overseas, will only make the FTSE 100 go up faster. So coming back to it, we've got a lot of ingredients locally, which I think are going to just continue to surprise on the upside. And if we do get a global recession, then I expect these equity income stocks to enhance their earnings growth, move into vacated markets, buy assets from a receiver like HSBC. And so, actually, instead of it being the kind of technology wizards of the world carrying on, actually it'll be UK quoted companies which get the greatest upgrades, and that's going to be quite shocking for a lot of investors who are in insurance funds and pension funds who are not sufficiently weighted, and especially local investors who have been selling recently. So I expect things to turn around. I'm more confident. I'm more upbeat about the UK stock market than I've been for 20 years, that. And specifically, I've been predicting the UK is going to outperform, and it is. And I'm predicting it's going to outperform a lot more than it's outperformed up to now. So don't be surprised if that happens, really.
Yeah, and maybe we can touch on that because I have seen some of your charts which date back to the 1940s and 50s, effectively, in terms of this effect lasts a long time. So maybe talk. We've seen a year ago when I think we did the budget, and at that time we were probably at the depths of equity market despair. You were calling for the fact that I think the UK is going to do very well. Cycle forward a year, it has done very well, but those charts that you show suggest that this is a multi-year sort of. Walk us through the duration of that.
Yeah, I mean, what's interesting is that you talked at the start about valuations, and valuations are lower. So one of the advantages of starting at a lower valuation is you get a better yield. So the yield in the UK stock market is already well above most international comparatives. So as a starting point, if your long-term return is your yield and how much it grows, the UK is already kind of one of the most attractive places in town. On top of that, as I say, depending on how things go, if you do find that many of these winners win disproportionately and the losers lose out disproportionately, then you can find that actually the earnings growth, as I say, in the UK accelerates, and that means dividend growth accelerates. So specifically, I'm expecting UK to outperform, not just because it's got a better yield, but actually income growth is going to surprise on the upside, albeit that there will be margin pressure, albeit that there may be a global recession along the way and all the rest of it. But perhaps most interestingly for me, when you look back at the charts of the 1960s and 70s, when the UK was not just a market which kept up with the US, but massively outperformed the S&P 500, was actually, it wasn't just the FTSE 100, the international companies which actually did well. Many of the domestic companies, I'm talking the 250 companies, the FTSE AIM stocks equivalent in the 1970s, didn't just keep up with one of the top performing markets in the world, the All-Share Index, but actually massively outperformed. How did that happen? And it was not because actually our economic conditions were good. We had, sterling crisis. IMF came and rescued the UK in 1976. We borrowed 4 billion in a hurry from the IMF because we were so indebted and such like. I hope that doesn't happen again. It could do. But most particularly what really happened was when you were buying companies from the receiver, it's great for HSBC to make a few billion by buying SVB UK. But it's already standing at 150 billion already. It's a nice uplift, but it's not going to change anyone's life. When you're a £1 billion company and you do a deal like that, you're not going to add 1 billion, but you might add a few hundred million, and proportionally that's so much bigger earnings upgrade. And as you moved into the sort of small caps, the 250 million market caps, you get disproportionate. So you get the small cap effect in spades. Effectively, the smaller the company, the better the chance if they do an insolvent acquisition for £1 and they get the uplift, to actually get that acceleration. So interestingly, I'm not just expecting the UK stock market to be one of the best performing stock markets in the world, but I'm actually expecting the small cap effect specifically to come through in scale. Now let's just remind ourselves, over the last 5 and 10 years, and particularly even in the US, the S&P index has been outperforming the Russell 2000, the FTSE 100 has been outperforming the AIM market and the 250. So coming back to it, we're actually looking at a period where small cap effect has been absent. I think you can summarise in a way that globalisation has been all about bigness. And bigness has done so well, and there's index funds, all the rest of it. My kind of summary is that actually in nationalism it'll all be about smallness and localism and all the rest of it. I was just speaking to Shepherd Neame yesterday. It's a quota company, but most particularly, what a terrific company. I mean, what a brilliantly well managed company. We're not shareholders, Mo, but doing everything right, and it's a local company, and it's superbly placed. It's undervalued, being a UK company, all the rest of it. So I'm just using that as an example that actually just shows that it's not just about the fact that actually, the UK happens to be a lot of equity income, and I think that's going to be an important feature. It's the opportunity for quoted companies to make disproportionate uplifts on acquisitions from the receiver. This is unhappy. People will be made redundant. There will be companies which become insolvent. There'll be, this isn't a lovely time, but boy, do we, this is the kind of unwinding of government's overspend, which has been in place really for the last 10 or 20 years.
Okay. So, let's try and, firstly, let me just take a pause there. That there are some questions coming in. So just for those watching, if you do want to ask a question, please type it into the chat, and we will try and attend to those shortly. Knowing what you know after yesterday, if you're going to sort of sit down in front of a new company next week and sort of be introduced to them, walk our audience through the kind of questions that you're going to be asking of the management team that fits your sort of framing of I am looking for an outperforming company.
So the key issue isn't just about valuation or whether there's opportunity to make acquisitions which will provide uplifts on the deals. Those will come when they come, and we can't say when the recession will be there or the insolvent companies will be there. But what you can say is, as a general pattern, unfortunately, I think we're looking at a period when profit margin is going to be under pressure. Wage pressures will continue on. I think even if you make redundancies, I think there'll still be the cost of wages will still be higher than they were previously. Your profit margin will be under pressure. You're generating less cash. As a general rule, it's going to be a tough period. That's good news for companies which are well managed. So you want to buy companies which are investing and have strong management teams. But most particularly, what it really means is that most of your competitors are going to be cutting their prices to keep their customers. So you've got to think, why is anyone going to carry on paying me my full prices when everyone else is offering the same service for half price? And coming back to that, the summary of that answer is customer service. And what we have seen over recent years is that actually companies, they don't talk much about customer service, but we talk a lot about customer service with them. And so, I was just seeing this week, I just saw AO.com, or AO World, they get 4.9 stars out of 5. What? And they've just introduced telecoms. You can buy your iPhone 17 for £17 a month for the next 2 years with an automatic upgrade after that. What an incredible offer from a company with outstanding service. So coming back to it, when you've got a combination of a very strong management team and very great attention to service levels, I think that's going to be a really important feature, because it's no use investing in a company where the profit margins come down, they don't generate the profits they thought they were going to go, they run out of cash and all the other things. The second thing is that actually it's no use just having good customer service. You've actually really got to have very well motivated frontline staff. So again, tell us about your surveys, about how you know it. Again, coming back to Shep and Dean, I saw them yesterday as well. But the point is, what outstanding, they are so driven by customer service. They're so driven by motivating their staff, bringing kids from school into their chef training and all the rest of it. So those two are absolutely important. Of course, alongside that, you need economic fundamentals. You need to be generating cash. You need to have a safe balance sheet. You need to have a product which people are going to be wanting. But those two questions, customer service, motivation of staff, I think are going to become horribly important to clients investing in stocks in the future.
Okay. There are some questions coming in, so let me just touch on those.
Right.
One of them is around a capital allocation. So the government has taken various measures to try and improve effectively the flow of capital into the UK. One of them is the Mansion House Accord, which is still voluntary. For flows truly to turn direction and for us to see significant flows in the UK, does this accord actually need to be turned into mandatory legislation? What is your take on that in terms of pension funds allocating to the UK and being forced to being allocate to the UK?
Yeah, I think one of the problems with the Mansion House Accord is it was a bit ambiguous about whether they really wanted more private companies or whether they wanted more quoted companies. They kind of, after the event, said that AIM companies counted as technically unquoted or unlisted or something. So they do fall within the Mansion House Accord. But I felt it was a bit sort of churlish. I don't think that wasn't the primary objective of what they were saying. So coming back to it, whilst I think private companies certainly have a role and all the rest of it, I do think that actually the government itself needs to actually put much more attention on quoted companies. You might argue, with the changes in the PEP, that the ISA, that things are getting slightly better, but they really haven't got round to it. Coming back to whether this is mandatory, if I was in government, would I make it mandatory? Even if I did, I would have a sunset clause, a year or 2 or 3 just to get across the bottom. Ultimately, if you're doing it for mandatory reasons, then ultimately people feel they're being made to do something which they don't want to do, and you've sort of half lost the argument on that basis. So whilst you could argue one way and the other on mandatory, I do think companies, pension funds, insurance funds, all the rest of it would be doing themselves a massive favour by going overweight equity income stocks, by buying more UK stocks. And it's not just doing a favour in terms of return. I think it'd also be doing a favour in terms of generating extra jobs. I mean, the UK stock market, when it works well, doesn't just, help pensioners make more money, but it actually helps the companies themselves to generate more employment. It helps skilled jobs get created in the UK. It helps, hopefully, companies to be in a position where they can get productivity improvements so they can pay wage rises above inflation on a sustainable basis. And also, being, in many cases, local companies, I'm talking about small companies in many cases, then actually, when they succeed, the exchequer tax take on their profits goes up as well. So ultimately, actually, I would argue that there's a lot of here. I think nationalism, as we get into it, will move on to our local savings actually and say, why on earth are we creating more jobs in the US? Right? Bring our capital home, generate more local jobs, and if we happen to be one of the best performing markets, of course, that will be a stampede in due course.
Okay, a follow-up question. Neil Whitehall asked that question about the Mansion House Accord. Bob Meadows, it sounds as if you're more enthusiastic about smaller companies. Is this FTSE 250 or is it AIM?
Well, if you look at the data, then the long-term effect is that small caps, the smaller company, the better returns on average. That's a significant point, the average. Lots of small companies don't do very well. Some do fine. Some make out like complete bandits. So coming back to it, whilst the 250 is got some very good companies in it, and we do hold some 250 stocks. So we're upbeat. I think AO.com or something. But most particularly move down the size bands. What's interesting at the moment is there's been a sort of pattern where even most professional small cap funds have sort of generally congregated in a limited number of major holdings in the 250, the top end of the small cap index. And they've done very well, actually. The 250 index has done extremely well over the last 10 and 20 years. But coming back to it, I think they need to move down the market cap range into some of the mainstream small caps, into some of the small and micro cap companies. The UK stock market is almost unique in the world in having such a vibrant universe of companies below 150 million market cap. And if you get these uplifts in earnings due to the acquisitions from the receiver, there's many more deals to be done in the bottom end of the market, and many of the upgrades are going to be more substantial. And as they get bigger, of course, institutions get interested because they've become larger, they've got more liquidity, etc. So you get this kind of tailwind built. So coming back to it, in summary, the smaller the company, the better the return. Don't just limit yourself to 250 companies. I'm expecting the small cap index, the Numis 1000 index, for example, to outperform the Numis small cap index, which will outperform the Numis mid cap index, which will outperform the Numis large cap index. So coming back to it, all of those indices, I think the smaller is the better is the kind of watchword on this.
Okay, and then one final question which actually been emailed in to me. When you're thinking about the OBR and its forecast and what the Bank of England is saying in terms of interest rate, sort of inflation expectations, I think this is tying back to your thoughts in terms of UK valuations and in particular how you think about the cost of capital. Do you anticipate there is a sort of further rate cuts and that there is going to be more valuation support for the UK market as a result of that?
I think in the short term we can expect more interest rate cuts, yes. I think inflation isn't going to be too onerous in the short term. I'm expecting the Bank of England to cut shortly. So I do think that'd be helpful. I think it'd be good for the housing market a little bit. It'll be helpful for some corporates. But I don't think that's the trend. The trend is that actually, unfortunately, longer term, I think that actually, unfortunately, the inflation will be more persistent, we all think. Now, don't get me wrong, it won't just be inflation. There'll be bouts of deflation as well. China and perhaps some of the manufacturing economies have got far too much capacity. They can't sell it all to America. They'll be dumping products all around the world. There will be deflation and inflation, both of which are adverse, actually, for corporate profitability. So I do think that actually, I think inflation will come back. My working assumption is that actually, in time, we find that actually the government runs out of money. I think that's particularly because unemployment goes up. What's been interesting about unemployment is it's already starting to go up in the UK, unfortunately, from 2023. And alongside that, and interestingly, we've already seen the savings ratio beginning to increase. So the savings ratio, which was as low as 5% in the UK ratio in the first quarter of 23, has now reached 11.3. So people are precautionary saving. This isn't like during COVID when we were kind of locked down, we couldn't spend anything. So coming back to it, all of this is just saying people are beginning to say the current status quo is getting less sustainable. We need to change. People are doing more saving, but we're going to get equally a change of pattern in terms of investors. We need companies which are safer. We need companies generating surplus cash. That's why the UK is going to outperform. So coming back to it, all boils down to the same thing, which is that actually the world's becoming less safe. A range of outcomes is a much wider range of outcomes, and it's not just a case that you need to think about investing in big and small companies or equity income stocks, but actually you need to invest across the full range of industry sectors. I'm not saying that the gold price is going to go up from here, but boy, if you had a few gold miners over the last 3 or 5 years, you've made out like a complete bandit. So actually, including energy stocks, including some complicated financials, including some of the kind of companies which you just feel a little uncomfortable about, means that actually you get more diversification. One of the things we're doing with our portfolios, Martin and I, is we are really being very, very attentive to increasing and maximising diversification, because you just don't know what's going to happen. And when you do get an uncertainty, then actually at that stage you find some companies get, your prospects are reduced. But on the other hand, you could find that the prospects of some of the others actually do unusually well. So portfolio diversification in terms of industry sector is also tremendously important.
Okay, and we've talked about the importance of yield in the world you're talking about. Question: how do you see from John? How do you see dividend growth, or how do you think about dividend growth?
Well, first of all, I think dividends are tremendously important in that it's not just that they pay dividends, but if you are going to grow the dividends, that costs you more money. And the reason I mention it like that is because actually what I'm really saying is that, sorry, I'm just going to turn off this incoming call, is that actually, if it costs you more money, you don't do it as a kind of signal unless you really, really mean it, right? So I love dividends and dividend growth as a key measure, and you certainly don't do it if your company is going to run out of cash and all that kind of stuff. So I think yes, there will be companies which produce good and growing dividends, and I think that will become one of the key measures of health of a company, not just in terms of obviously the current balance sheet, but also the ability to generate cash and earnings, and even at a time perhaps when the margins are under pressure. So I think good and growing dividends is going to become more and more important. Of course, if I'm right about the future and we do get the zombies all going bust, and if we do find more indebted companies and loss-making companies going bust, then those can be acquired from the receiver, often for a nominal sum. Clearly, they've got to be viable companies, they've got to be generating surplus cash, but you can get acceleration of earnings growth, you can get acceleration of dividend growth, you can get acceleration of the ability to pay good and growing dividends. So coming back to it, I think ultimately, I think the ability of a company not just to pay dividends, but to grow its dividends steadily, as a dividend hero does, will become overwhelmingly important, not just in terms of the valuation of a company, I think it will be, but actually even more importantly, if you're going to be raising capital to take over a company for £1 that it needs 30 or 100 million of working capital, that you can then raise that cash at an attractive rate, get the earnings uplift in terms of the acquisition, and accelerate and do a series of those acquisitions over 3 or 5 years. So coming back to it, I think income and income growth, the ability to grow dividends, will become overwhelmingly linked with the ability to raise capital. So we're a long way from where we've been in the past, and that's what happened in the 70s and such like. So coming back to it, I think in terms of the rate of dividend growth, we've always thought long-term 5 or 7%. That, of course, includes the inflation. So inflation's 3 or 4. That's 3% real. I think there will be some companies which achieve way above that. Those are those which are very successful, and many of those will be small companies. So I'm very excited by the opportunity. Alongside, of course, there will be companies which get caught out. There'll be companies which run out of cash. They have to cut their dividends. That's a disaster when it happens, not just for the company, but the ability of the share price and the ability to raise capital, the dilution of capital, and the rest of it. So I think the range of outcomes is going to be wide. Pay great attention to the strength of the balance sheet, pay great attention to the ability to hold on to margin, but most particularly, obviously invest in companies which are generating surplus cash and accelerate that earnings growth and dividend growth.
No, thank you very much. And John says that you answered that very well. So thank you, Gervais.
That's
I think we're coming. We're coming up to sort of time. I just wanted to give you the opportunity. So let me summarise. Okay, not a great budget, but because the UK is structured in the way it is, essentially, and what is going on in the rest of the world, actually the UK continues to look attractive. What are your thoughts in terms of, or if you had to summarise where you are today and what we talked about, what are your sort of key takeaways for people thinking about investing in the UK?
Well, first of all, I think good and growing income is important. I think big companies, small companies. But probably the thing I would probably overwhelmingly talk about is the ability to differentiate between winners and losers. Really, the last 30 years, everyone's won. Some have won a lot more than others. The UK has underperformed. The US have gone up a lot more. But most particularly, I haven't been in my career in a position where I've been able to select companies with what I consider to be abnormally strong upside potential through, stock picking. It's probably the best period of my entire career, right? Of course, there will be those which don't do it. There'll be unexpected events which catch up some of my selections out. It's certainly not a silver bullet of any kind, right? But the opportunity for active fund managers to make a difference for their clients is probably more significant over the next 5 years than it has been in any 5-year period up to now. And that's a wonderful responsibility. It is a responsibility. We have to be very thoughtful and careful and attentive to the risks we're taking on behalf of clients. But in coming back to it, if some of the things I talked about are correct in terms of the future, people will be not just surprised by how much the UK outperforms, but actually surprised by how much active stock selection can add on top.
Yeah. Okay, Gervais, as always, enormous pleasure having you on with the Edison team here. Thank you so much. A really good run through in terms of what the budget really means for the UK equities. And my big takeaway is actually you probably want to don't think too much about the budget. Think about the great companies in the UK and the opportunity ahead for them. Thanks very much.